Hi, grade 12s. Welcome to my YouTube channel. Today, we're going to look at financial mathematics and we're going to study a sinking fund account. So the purpose of uploading this video is to help you prepare for the upcoming mathematics paper one uh, this Friday. So before we answer this question that I've prepared for you guys, if you've not subscribed to our channel, please subscribe, like, share, and comment. So there's a question that I've prepared for you here, which is a question on a sinking fund. But to do justice to a lot of people who maybe don't understand what a sinking fund account is, I think it would be fair if I start by explaining what happens in this type of account, right? So in this type of account, which we call the sinking fund. So this account is an account that a business opens whenever they buy an asset. So business opened this account with the sole purpose of replacing the asset that they purchased in the future. So if a business purchases a car that costs 250,000 today, the business will want to replace this car some other time in the future. And by the time that the company will want to replace this car, obviously, if they want to buy a new car, the new car will not cost 250 anymore in the future. Because of inflation, the car will be costing more than 250,000, right? And then the car that they bought in the past, which is the current vehicle, will depreciate in value, or we say that this car will lose value. So what happens in the sinking fund account is that you look at two assets. The first asset is the, 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 the old asset. So we've got the old asset, which is the car that the company has already purchased, right? And also look at the new asset. So the new asset will be the asset that the company wishes to replace sometime in the future, right? So the old asset will always lose value with time. So we say that the old asset will depreciate, and then the formula for depreciation that we use the decay, the compound decay formula and the simple decay formula. So to calculate the value of the car after it has lost value, we use A equals to P1 minus I to the power N. So this is the depreciation of the old vehicle according to the reducing balance method. So they call it the reducing balance method, or they call it the diminishing balance method, right? So these are the depreciation of the old asset. And then sometimes they can say it depreciate on straight line method. So when it depreciate on straight line method, we use A equals to P1 minus I times N. So this one is when it's depreciating at cost price, or what they call straight line method. So that's what I want you to know, that every time the old asset will always lose value or it will depreciate. And then the A equals to P formula will give us the book value after depreciation, right? That is sometimes called the scrap value. So I'm going to emphasize that A give us the book value. So book value, or what they call the scrap value. So this is the value of the asset after it has lost value. So that was happened in the old asset. So in the new asset, which is the asset that the company wishes to purchase in the future. So this one, it does not lose value. So because of inflation, the value or the cost price of this new asset will increase. And then we say it is subject to inflation. And every time this new asset will increase by the compound growth formula, which is P1 plus I to the power n. So this is what happens to the value of the new car or the cost price of the new car after some time. So it will cost more. So let's go back to the example that we had of a car that costed 250,000. So if the company purchased this car at the price of 250,000, so if they want to replace this car after 5 years, for example, so it means that the company will need to pay more than 250,000 because the asset would already increase in the price because of what? Of inflation. So that's what we need to first know in the sinking fund account. So the second thing that you must know in the sinking fund account is that when the company wants to buy the new car, usually what they do, they trade in the old asset, right? So this is what happens. We're saying the old asset is traded in. So they trade in the old asset, or what we say is that they sell the old asset. So when they want to buy, the old asset is sold altogether at the scrap value, or it is sold at the book value at that time. So the money that they get from selling the old asset, they use it in purchasing the new asset. So I'm just gonna give you a scenario here that let's say, for example, after 5 years, um, the old asset, the old car, had a value of 43,000. Let's say it had a value of 43,000. And the new car costed 400,000. Let's say this is what we have. So the company is going to sell the old car at the value of 43,000. And the money that they get, which is 43,000, they're going to use it towards the purchase of the new vehicle. So it means that the company will not need exactly 400,000 to purchase the new car. So the company will need 400,000 minus 43,000 in order for them to purchase what? The new car. So that will be the money that the company will need in order to purchase the new vehicle. And that money will be equals to 357,000. So this is the money that the company will need in order to purchase the new vehicle. So if this is the money the company will need to purchase the new vehicle, this becomes the sinking fund amount, or what we call it, the future value amount. And the reason why we call it the future value amount is that this is the money that the company need to raise. It's the money that the company does not have right at the present time. It needs to raise this particular amount of money in order for them to purchase the new car in 5 years' time. So this becomes the future value amount, which is the F, and then we call it the sinking value amount. So that is what sinking funds is all about. So I hope the question that I've prepared for you will help you understand this topic. So let's check what we're given. So we are told that a company buys a car that costs 356,000. So this is the cost price of the car. The company wishes to replace the car at the end of 5 years. So they want to replace this car at the end of 5 years. The car depreciates at 15% per annum according to the reducing balance method. So this is the rate of depreciation. So I want you to know this is the cost price, and then this is the rate of depreciation. And then and also the method of depreciation is very important that you note it. For this period, the inflation rate remained at what? At 18.5% per annum. So this is the rate of inflation. The company opens a sinking fund account that offers an interest rate of 12.5% per annum component month. So this is the rate of the account that the business is going to open, right? So what I want you to note here, so I'll say it's an NB. In a sinking fund account, in a normal circumstance, the payment or the first payment should be made 1 month after the asset has been purchased. On a normal circumstance, the first payment must be made 1 month after the asset has been purchased. So it means that if a question comes to you and they say the first payment was made 1 month after the car was purchased, so this means that this does not affect anything in the number of payments that we're going to make, right? That is the normal circumstance. So if we're not told that the payment is made 1 month after the item is purchased, we're going to assume that this is what happened, right? But if the first payment is made on the month of purchase, we say that an immediate payment has been made altogether. Né? An immediate payment has been made. So if an immediate payment is made, the N will be equals to the number of compounding period plus a 1. If an immediate payment is made. So an immediate payment in a sinking fund account, it is when a payment is made immediately after purchasing the vehicle. But if a payment is made 1 month after purchasing the vehicle, the number of payments, which is N, is not affected at all. So I've emphasized this thing more than 2 times so that you always remember when you're dealing with a sinking fund account, right? So let us look at the first question. So the first question, they say, you must calculate the value of the current car at the end of 5 years. Let us remember what we did. We said that the current car, which is the car that the company has purchased, will depreciate or will lose value, right? And we're given the method of depreciation here. We are told that it depreciated what? At reducing balance method. So it means that the current car is going to lose value according to A equals to P1 plus, it's 1 minus I. So it's 1 minus I. 1 minus I to the power N. So we're trying to calculate the value, which is the book value of this car after 5 years. So the cost price, or the initial price of the car, was 356,000. 1 minus, and then the rate of depreciation. The rate of depreciation here is what? Is 15% per annum. So it's 0.15. So depreciation, it's calculated on a yearly basis, right? So we don't divide by the compounding period, we just write the 0.15%. And then to the power N. So N is the number of years. Here, the number of years is what? Is 5 years. So it means that we say to the power 5, and then we check the value of the car. So the value of the car after 5 years has to be less than 356,000. And the reason it has to be less than 356,000 is because the car will have to depreciate or lose value. And when we get here, we're going to get 157,959,09. So after 5 years, the car that costed 356,000 will now be having a value of 157,959.05. So this is the value of the current car after 5 years, right? So number 2, they want us to get the value or the cost of the new car at the end of 5 years. So remember I said, the new car will always increase in value because of inflation, right? So it means that we're going to use the growth formula, which is A equals to um, P1 plus I to the power N. So it means that we want to check that the car that costed 356,000, how much will it cost in 5 years' time? So the I here will be the rate of inflation, and the rate of inflation that we have there, it's 18.5%. So for I, we're going to write 0, 185. So 0, 185 to the power 5. So we want to check how much will the car cost in 5 years' time. So that will give us the price of the new car, which will be higher than 356. And the reason why it's higher than 356, I'm saying it again, it's because of inflation. So, and then this value is equals to 800 and it's 831,843,73. So this car that costed 356,000 today, at the end of 5 years, it will be costing 831,843.73, right? And then let's check here. They say you calculate the monthly installment that needs to be made into the account. Sorry, it's supposed to be account here. That needs to be made into the account in order to replace the car at the end of 5 years. So what you must know is that once we talk about installments or regular payments and an investment, we talk about the future value formula, which is F equals to X times 1 plus I to the power N minus 1 divided by I. Because we are talking about an investment question that has to do with regular payments or monthly installments. So it's a future value question. So from these, they want us to calculate the monthly installment that needs to be made into the account. So before we calculate the monthly installment that needs to be made into the account, we need to know how much the company will need in order to purchase this vehicle. So this vehicle, remember, it cost 831,843.73. But this is not the amount that the company needs. The company is going to sell the old asset, remember, right? And the money that they're going to get from selling the old asset, they're going to use it towards the purchase of the new car. So this means that the money that the company needs, which is the future value, it's the F value that we have here, will be what? Will be 831,843.73 minus the value of the old asset, because they're going to sell it, right? Which is 157,959 minus 157,959.09. So they're going to need this amount in order to purchase the vehicle. So it's minus 157,959, and then this will give us an amount of 673,884,64. So it's a value somewhere around this one. So this is the amount that they're going to need in order for them to purchase the new car in 5 years' time. So that becomes the F. So now when we are working with this question, we know the F now, right? So we're going to say, whether it's F, we're going to put 673,884,64 equals to we're trying to calculate the monthly installment, right? We don't know it's the X. So we leave it there as X. And then we've got 1 plus I. What is the I there? It's the interest rate of the account. And the interest rate of the account is 12% per annum, compounded monthly. So that is 0.125 divided by 12. It's compounded month, right? And then because here, we are talking about a period of 5 years, and they're going to make monthly payment. So we're going to take the 5, we times it by 12, right? And then we don't add a 1, or we don't subtract anything to the 60 because there is no delayed payment or there is not an immediate payment. So we add 1 if there's an immediate payment, and then we subtract the delayed payments if there's a particular payment that has been delayed, right? Then this will give us 60, and then which is 5 times 12, right? And then minus 1 over 0.125 divided by 12. And now what you need to get here is the value of X. So the value of X will be given by 673,884,64 times 0.125 over 12, and then you divide everything by 1 plus 0.125 over 12 to the power 60 minus 1. So this will give us the value of X, which is the monthly installment. And the value of the installment is equals to 8,141.38. So this means that in order for the company to reach their target of 673,884.64, they need to make an installment of 8,141.38 monthly. So that is an example of a sinking fund question. So let me remind you something here. Remember, I emphasized the fact that if there is no immediate payment and there are no delayed payments, the N will be equal to the number of the compounding period, right? But I just want to say this in case it comes. Let me just add this to this video so to assist a lot of you. So let's say, for example, guys, they say a company purchased a car, and they opened a sinking fund account. And then they say the first payment is made 6 months after opening the account. After opening the account, and then they want to replace or they're going to make payments for 5 years. So I want to ask about the N year. So what happens is that you must understand that this person purchased the car today, and then they're going to make the first payment after 6 months. So if they make payments after 6 months, and then this transaction will take place over a period of 5 years, right? So if they do not skip payments, the number of payments were going to be 60, which is 5 times 12. But because these people, they skipped or they delayed their payments, you need to subtract the number of delayed payments there, right? So if they skipped 6 months, how many payments they delayed. So here it means that these people delayed 5 payments. And the reason it's 5 payments that they delayed is because, remember, the first payment must be made 1 month after the asset is purchased. So every time there is a 1 month, we can call it a grace period, that they are supposed to make a payment 1 month later. So if they made the first payment 6 months later, it means that from the 6 months, there's the 1 month grace period that they are granted always. So we say they've skipped 5 payments. So therefore, the end that we're going to use in our future value formula is going to be 60 minus 5. You don't subtract the 6 because the 1 month, it's a grace month that they are given. I hope that this video will assist you in understanding questions on seeking funds, right? If you enjoyed this video, don't forget to subscribe to our YouTube channel, share, like it.